Hey, Jack Davidson here. Well, by now you've probably heard about all the new changes to the rules governing mortgage lenders that are just on the horizon, scheduled to come out on October the 17th. So I hope that this will help to explain a little bit about what's going on and maybe alleviate some of the fears surrounding everything. So let's start with a little bit of background. We all know that an insured mortgage is for any home buyer with less than 20% as a down payment. Now, in those cases, those mortgages are insured, and they're insured by Canada Mortgage and Housing Corporation, that's CMHC, Genworth, or Canada Guarantee. And the associated insurance premium is then passed down onto the borrower. It's really a system that was designed to provide security to the lender in the event of home buyer default. A non-insured mortgage, on the other hand, is when the buyer has 20% or more as a down payment and therefore is not required to pay that mortgage insurance. So what are these changes that are happening? Well, currently, insured mortgages with a term of less than 5 years or a variable rate mortgage has had to qualify at the Bank of Canada rate. That's the BOC rate. However, under the new Department of Finance regulations, all insured mortgages, regardless of the term, whether they're fixed or variable, it makes no difference, it will now have to qualify at that BOC rate. And that's the posted rate, currently sitting at 4.64%. So how does that all impact everything? Well, the biggest effect will be really on the amount that the home buyer will be able to qualify for. Now, previously, the 5-year fixed qualified at the lender contract rate. Now, the home buyer has to qualify at the Bank of Canada rate. So, for example, the 5-year fixed mortgage at 2.39 was qualified at 2.39. But under the new rules, a 5-year fixed mortgage at 2.39 must be first stress tested by qualifying it at the BOC rate of 4.64. So the net result of all of that is really about a 20% reduction in the amount of the mortgage money available to the buyer. To put it in real terms, think of a combined household income of, say, $80,000. That might have qualified for a $500,000 fully detached two-story. But under these new rules, the qualification will get reduced to $395,000. And that could translate into, say, a much smaller home or even a townhome instead. The good news is that for a simple renewal at the end of your term with the same lender, there should be no problem whatsoever. And there really is no significant impact that's anticipated for home buyers with a 20% or more down payment. So home buyers will still have the ability to refinance up to 80% of the value of their property, although the specifics might differ a little bit from lender to lender. These changes will definitely impact anyone looking to get into new financing or anyone thinking of shopping around for a refi with a different lender at the end of their present term. Now, to put this all in perspective, think back to 2008. Those fixed rates were sitting at 5.99%. So that was a lot higher than the current qualifying rate of 4.64. So overall, interest rates that borrowers can get still remain pretty much at record lows. So there's really no need to panic. But just remember this, the best advice is before you go looking at homes, I know it's very enticing, but before you shop online and do all of that, get pre-qualified by a lender or a mortgage broker first. That way you'll know exactly what you can afford and you can come in on an offer with confidence. If you'd like any other information on the current market, feel free to get in touch with me anytime, and you could even reply to this email. Until next time, I'm Jack Davidson. Have yourself a great rest of the day.